In the past, I've been very critical of Jerome Powell's views on interest rates. When Trump first came into office, Powell said, I'm going to be very strict, I'm going to be more hawkish, etc. Then he got a little political pressure, and all of a sudden he was keeping rates low, etc. Lately, inflation has reared its ugly head. It's given Powell an opportunity to start raising rates and raising them very aggressively. It has caused markets to fall this year, according to many people, and that makes sense. If your justification for high values was low interest rates, then when rates go up, it should justify much lower values. Now, in my opinion, based on, if you look at our videos in the past, I think stocks are about double where they should be. Does that sound crazy? I know. But go find those videos. I explain it very thoroughly. 3 very reliable metrics: stock market to GDP, 10-year, cyclically adjusted PE ratio, and the price to sales ratio. They're all very reliable long-term metrics. Okay, now, what happened on Friday? Friday, markets fell over 3% each. The NASDAQ fell 4%. Today, markets down. The NASDAQ's down almost another 0.7%, and the S&P and Dow are down 0.7, 0.75. So, on Friday, Powell pulled a Paul Volcker move. For those of you who don't know who Paul Volcker is, he was the Fed chair back in the early 80s when there wasn't Twitter, there wasn't as much news. So Paul Volcker wasn't as, right now I believe Jerome Powell is heavily influenced by his public perception. I don't like that. The Fed chair is supposed to be the Fed's supposed to be an independent body that's job is to worry about inflation, which is basic consumer prices, and employment. But we've had very low unemployment numbers, too low. So low that they're causing high inflationary levels. We were giving money out too quickly, causing inflation. Now he has this excuse to go raise rates. And on Friday in Jackson Hole, Jerome Powell absolutely crushed markets by saying that there's going to be a lot of pain coming as they try to keep prices down. And this is going to be done through rising interest rates. A lot of people have also been talking lately about him decreasing rates sometime next year. We're trying to refinance a property right now, and our bankers are trying to encourage us, no, rates are going down next year. Frankly, it doesn't matter to us. We're not playing the interest rate guessing game. That's not part of our job. But the point is, everybody thinks that's going to happen. But on Friday, Powell was very specific, and he said, history has not been kind to those who prematurely loosened monetary policy. What that means is lowering rates to make money easy to get out there. We lowered rates for a specific reason, and from COVID to make money much easier to get, to make lives easier for people. And I get that. But now it is time to tighten. The economy we had in the last 12 years and 13 years is not a normal economy. It is not sustainable over long periods of time. I always tell people, yes, you want low interest rates, you want high minimum wage, great, you're going to have inflation. And back in 08 and 09, when we had loose monetary policy, we didn't follow up with high inflation. Why is that? Well, I was one of the people wrong about that. I thought, how is this not going to cause inflation? Well, one reason is it wasn't given to the people. It was given to the banks. If we give the money directly to people, they're going to spend money. It's going to cause good demand to go up. And these things that will happen. Today, I was at McDonald's in the morning, and there was literally a sign that said, our dining room is closed due to lack of help. When you had people getting checks at the time before for doing nothing, where's their incentive to go work and lose that check? Okay. So with Jerome Powell, he said these things and it rocked the markets. They fell Friday. They're falling more today. People have to realize that there will be more Fed tightening as time goes on. So what does that mean for you as a consumer? Well, very simple. You borrow money. How do you borrow money? House, cars, credit cards, education, etc. These are ways you borrow money. As rates go up, this goes up, this goes up, this goes up, this goes up. And if you're making $40,000, $50,000 a year, these few percentage points on these kind of things can really affect your bottom line and your personal free cash flow. That's how it's going to tighten the economy. You're going to spend less on discretionary items, which will slow everything down. Remember, GDP is 70% consumer spending. 70%. 70. So if consumer spending drops just 5%, that's a 3.5% drop to the economy. That's a big number. We've already seen 2 quarters of GDP contraction. And spoiler alert, I don't think the Fed's upset about that. And I also don't think the Fed's upset about inflation as much as people might think. Why? Because with so much debt the U.S. has taken on in the last 15 years, the only way out of that debt, there's two ways out of that debt. Pay it down, good luck, or two, inflation. Why? Because right now the debt's at 30 trillion. And the U.S. economy is, I don't know the exact number, call it 22 trillion. It looks like 140% of GDP. But if all of a sudden we had such massive inflation that it made this GDP go to 40 trillion at some point faster, now 30 trillion out of 40 is only 75%. It brings your numbers much lower, assuming we don't print more. Now, that's quite the assumption, I get that. But even if you have deficits of $500 billion, you can spend 10 years at $500 billion and still be under 100%. That's a big key that people don't realize. The Fed, behind closed doors, I'm sure has not been as concerned about inflation as they might be letting on. Why? Because they want to inflate the heck out of the dollar. They want to inflate the heck out of GDP. They want to have that thing skyrocket. Now, for those of you who have a house or looking for a house, you might sit there and worry like, okay, and by the way, housing has absolutely slowed down. You look at prices of homes in the last year, they're up a ton. But look at the last few months, the major markets are seeing pullbacks in pricing. You're seeing major cancellations of new construction and existing homes. These contracts are falling out. Why? Because a year ago, at some point in the last year and a half, rates were 2.75. Now they're 5% or more. That's almost double. At one point, we had 30-year rates at 6%. That's over double. So what does that mean? Well, on a home mortgage of $300,000, if your rate goes up from 2.75% to 5.5%, that's an extra 2.75. 2.75% on 300 grand is an extra, what is that? 3% is 9,000. So 2.75 is call it $8,000. Divided by 12, that's $666 a month. Is that correct? Something like that. Okay. $666 a month. That's a lot of money for somebody who owns a $300,000 house. You might be surprised. You might be watching it going, that's not a lot. It is a lot if you own a $300,000 house. You might make 120 grand a year. Okay. It's $8,000 of 120 grand. That's a lot before taxes here. That's a lot of money. These Fed hikes do cost people money. We've also seen in history, if you look at history, that during recessions and during increase in rates, profit margins shrink on companies. So as profit margins shrink and there's less demand for the goods, it's really going to drive down overall profit margins for a company and therefore drive down prices of stocks. So you not only had a drive down because of the interest rates going up naturally, but you also have a drive down because it's going to tighten the profit margins for companies. This might sound scary, but remember, I'm Paul. I'm a value investor. My goal is to look at the long term. I'm not focused on the day-to-day results. I look at what happens in the world and what the reactions are, and I make my decisions based on that. I'm not trying to guess the future. Just like I said before, the bankers are telling us rates are going to go down. We don't care. We have a good property that's gone up in value a lot because of increased rents, and we would like to refinance. If rates go down 0.5% lower than they were, fine, we get lucky. If they go up 0.5%, fine, we get unlucky. Our goal is just to pick there and say, hey, even if rates go up 0.5%, we're still okay taking this mortgage. That is my goal as a value investor. That's what I want to teach out there. Don't worry about the day-to-day, week-to-week, month-to-month reactions. Go look at the long run. Pick good companies at good prices. Be patient, but most importantly, dollar cost average, because you never know what's going to happen. 12 years ago, I would have never, ever thought that the S&P would hit 4,800, and it did. That's an incredibly huge bull market. 5. Where am I going to on this one? The recession? Yep. So if you like what I've said here, please watch our next video on recessions could be the opportunity of a lifetime for you to build generational wealth. Please subscribe to our channel. Thank you very much for your time.